Welcome to The Derivative by RCM Alternatives, where we dive into what makes alternative investments go, analyze the strategies of unique hedge fund managers, and chat with interesting guests from across the investment world. Greetings, humans. Yes, we're bypassing the normal Star Wars hello there because our guests today are Trekys, and not just casual fans. They actually spoke on the similarities between sci-fi and investing at a Star Trek convention once. That's a new one. It's Brad, Barrie, and David Johnson of Dynamic Alpha Solutions, who run an outsourced CIO business and started a mutual fund that's a bit of a twist on the latest trend of marrying traditional stock exposure with a non-correlated alternative investment. We've seen that done with long volatility, we've seen it done with managed futures and trend following, but Dynamic Alpha is pairing discretionary global macro with their stock side. How does that work? Can it still provide the crisis period performance? What can discretionary managers do that systematic can't? We dig into it all, concluding with some of those Star Trek and investing corollaries, such as when you should put shields up in your portfolio. Engage. This episode is brought to you by RCM's Clearing and Execution Group, which helps mutual funds like the one Dynamic Alpha runs efficiently access and trade exchange-traded futures and derivatives markets. Visit rcmalts.com to learn more. And now, back to the show. All right, everyone, we got Brad Barrie here and David Johnson. Brad, you got a lot of letters after your name there. What are all those letters for? Certified financial planner?
Yep, certified financial planner, chartered financial consultant. I was a financial advisor for about 20 years, working with some wonderful people in the Chicagoland area. So,
and then you left Chicago, right? Where you went to Vegas?
Yep, yeah, I left Chicago, kind of transitioned my practice to my partners, and I moved to Vegas for Peace and Tranquility. Which
Really?
is not where normal people go for peace and tranquility, but where I'm at, beautiful mountain views and sunset behind the mountains, and it's better weather than Chicago most of the time.
And if you're living there, like draw parallels with Chicago for me. So you're in like Evanston of Las Vegas, or what's your Chicago equivalent?
Yeah, funny because I used to live in Evanston when I was in Chicago, and lived in a few other areas there. But yep, so I'm in Henderson, Nevada, which is just south of Las Vegas. It's definitely considered a suburb, with again, wonderful people. It's a wonderful place to live, and all the wonderful.
How often are you like down on the Strip, seeing a show or doing stuff like that?
Not very often. It's funny as a money manager. Sometimes I'd have clients back in Chicago, and I would visit Vegas, and they're like, "Oh, you're visiting Vegas, huh? Are you taking my money with you?" Or and those that know me know I'm not a gambler. I don't drink. I don't smoke. I'm kind of boring. But it's nice because it's there when you want to get to it. If you want to get to it with ease.
I will put it in the show notes, but I wrote a blog post once. Michael Geismer, I think is his name. Anyway, this hedge fund manager guy, he won like 240 grand playing blackjack during SALT, I think. And so someone got a hold of it and wrote this article of like, this guy's risking all this money, blah, blah, blah. And the blog post did some quick math of like, he's making, call it 1% on 1.8 billion. And even if he gets X% of that, like, he was risking even if he was risking $1,000 per bet, it was basically like the rest of us risking $5 a bet. So let the man have some fun.
Absolutely.
And David, where are you at?
I'm in the Tampa Bay area.
All right. Right across Route 70, 50. It's been too long. 70. What gets me over to Vero?
75.
Yeah.
70, Interstate 75.
The straight across the
Clearwater. I-4 goes to Orlando.
Yeah, I'm saying I want to go right from Tampa over to Vero. There's like that little state route 70, I think it is.
Yeah,
60 maybe.
That's Highway 60.
Yes. All
it's
right.
like a road you want to avoid at all costs.
Exactly. Let's get into a little what you guys are doing, what the firm is doing, and then I want to get into some sci-fi. So
absolutely.
First tell us about the firm, the background and how you founded it. You gave us a little teaser of leaving the advisor space.
Yeah, so our firm is Dynamic Wealth Group. We run two main businesses. We run Dynamic Alpha Solutions, which is an outsourced chief investment officer business where we support financial advisors, helping them build truly diversified portfolios, and helping them, provide solutions to their end client. And we also run Dynamic Alpha Funds, where we manage a mutual fund, the Dynamic Alpha Macro Fund. The ticker symbol is DYMIX, DYMIX. It's an interesting background on where we got to where we are. Being in Vegas, one of the nice things is I do go to a lot of conferences and conventions. So I'll go to the Strip not to gamble, but to go to investment conferences. Again, I mentioned I'm kind of a boring person, but I'd rather go to an investment conference than go to the casinos to gamble. And I met David at an AAII conference about 6 years ago, the American Association of Individual Investors, and met David there and befriended him. And David was representing a number of alternative investments. And I invested with him, befriended him, and again, we'll dovetail into the science fiction conversation in a little bit. But we learned that we're both avid Star Trek fans, and kind of through the relationship developed. And at the time, I was consulting financial advisors, kind of as an OCIO and an overall practice consultant, and I had invested in one of the hedge funds David represented, and David kind of mentioned to me, like, do you think other financial advisors would be interested in this strategy? And I'm like, I think so. I was interested in it. I've invested in it. It's unique. It's differentiated. Let's talk to some financial advisors. And we presented at some conferences and got amazing feedback. Financial advisors were like, we love this. We love this strategy. It's non-correlated. It performs extremely well. What's the ticker? And that was the issue, because it was a private placement, accredited status, 2 and 20 fee structure, and financial advisors like more turnkey, easy to implement solutions and products. So through connections and research, we worked on launching a mutual fund, and it's we'll dive into the mutual fund as the conversation goes, but it's an innovative solution that combines a global macro fundamental approach with equities. So and I think as the conversation goes, we'll dive a little bit deeper into that on how and why we did it, and it's managed. But that's kind of a.
We'll now fact check you with David's recollection of the events. Is that how it went down, David?
Absolutely.
And what were you doing at the AAAI? What is it? AAAI?
I spoke there, and this was back in like 2018. This was before COVID.
Yeah. And some of those give me like a lot of tire kickers, right? Do you feel that, or you felt it was worthwhile for like a money manager or an advisor?
It was for me because at that time, my main business was, I was actually an IB.
Yeah.
And so I represented a lot of CTAs.
Yeah.
And I basically went there to educate people on, how managed futures works, how it can differentiate your portfolio because it's uncorrelated, but the stock market, all this stuff.
Mm-hmm.
And they weren't getting any of that. They were just getting this stock guy, that stock guy, this stock guy.
Yeah.
And so, I saw, I did that for probably, 7 or 8 years at least, in the mainstay. Met a lot of people and educated a lot of people. So it was fun. I got to know a lot of CTAs, got to know how they did what they did. I used to design trading systems back years ago when I was working in FX, after I left aerospace. But this was a little different.
And give us that little left aerospace. What were you doing in aerospace?
Well, my first career was at NASA, and I was there for a short time.
NASA.
NASA, Marshall Space Flight Center in Huntsville, Alabama. Yeah. It's where they built the Apollo rocket.
Right. Is that where they send the kids now to space camp and all that?
Yep, exactly.
Yep. Awesome.
Yeah. It's where they always had space camp.
Uh,
So
and were you designing rockets, designing flight plans? What were you doing?
I was a space shuttle engineer. I was working on the shuttle, on some subsystems in the shuttle. And that was, I was a junior engineer then. I was, very green. But I figured out very, very quickly that NASA didn't really design things anymore. Like after Apollo, it's all contractors,
Yeah.
space and defense contractors, the Lockheeds, the Northrop Grumman's, they do all the fun work.
Yeah. Doesn't that
So
scare you a little bit? Like if there's, right, how many subcontractors are putting all their stuff into this one?
hundreds, thousands.
Right. That scares me of like, how do they all know those systems are going to work together?
Yes, single point failures. Yeah, that's one of our favorite subjects. I was actually, so I became a systems engineer. I went to work for Honeywell Space Systems here in Clearwater.
Hmm.
And I worked there for about 22 years and had a wonderful career there. It was a lot of fun. Worked at Johnson Space Center for 5 years and on the space station program.
Nice.
And talk about a complicated project, the most complicated thing ever put in space.
Right. And now
So
they're talking about they might scrap it, right?
I know. And they don't have anything to take its place. Like the shuttle, they scrapped the shuttle, didn't have anything to take its place. This is our government at work.
Yeah. That's a separate podcast.
Yeah.
So the two of you
So
and said,
yeah,
hey,
so I basically left that and I got into, just basically took early retirement, wanted to do something different and got into
the
basically
only thing
studying the
crazier in
markets.
space, futures, right?
Yeah, exactly.
And then it was a
Well,
natural fit
options
of,
maybe
yeah.
options are.
So Brad, you're saying, hey, I know this stock side, this, and David, I know this alternative side. Let's marry them together.
Yeah.
Yeah, and there's definitely the linkage. One of the things that David said that resonates with me is the education component. David loved educating folks on the alternatives and what they are and how they use. And as a financial advisor, I always viewed part of my role as to help educate investors and my clients on different financial planning aspects. So, there's definitely a lot of the similar thinking. David actually tells a story about when he was at NASA. I love this story because it talks about defining the right problem. And David, I'll paraphrase it, but feel free to jump in. But when you think back to was it the Apollo program when they were originally trying to send astronauts up to space?
Yeah.
Were,
So basically, one of the lessons I learned from my emeritus engineer who was mentoring me when I first got there was the whole idea is that the first 50% of solving a problem is properly defining the problem up front.
Yeah.
And most people skip that part. So they wind up with a solution to some problem, just not the one they're trying to solve. And that's basically what happened. The reason you told me that story is that's what happened with the space program early on. They tried to figure out a way to get this capsule and the person in the capsule back down to Earth without burning the capsule up. So they tried to create an indestructible material. There is no indestructible material.
Right. So let's figure it the other way. Isn't it? I think Einstein has if you give me an hour to figure out a problem, I'll spend. If you give me an hour for a problem, I'll 55 minutes figuring out the problem and 5 minutes on the solution. Yeah.
Exactly. So finally, an engineer one day said, "Hey, guess what? We're solving the wrong problem. The problem is to get the astronaut back alive, not to create an indestructible capsule." So they came with the ablative heat shield. So used
it's going to get uncomfortable in there, but
yeah, it's going to get uncomfortable, but it's going to get you down. It's going to last just long enough.
I love it.
That's a great example.
And taking a step back, Brad, on the OCIO side, do you see that as, are more RIAs shifting to that, or more RIAs separating, like, hey, I'm your golf buddy, I'll take you out to golf, I know how to get relationships, and then it seems so old-fashioned that we thought that the same person could be the person head down solving complex financial metrics and figuring out the right portfolio. It's the same guy who wants to go have beers and golf and do all this. And I'm sure they're out there, right? They exist, but It seems like we're moving towards a point in the advisor industry where those two are become decidedly separate.
Yeah, I mean, again, having been an advisor myself for 20 years, advisors are pulled in many, many different directions. And, whether it's understanding whether a client should do a Roth IRA conversion or not, or should they retire at 65 or 67? What about Medicare? What about estate planning? What about their insurance needs? What about cash flow management, debt management, generational? I mean, there's so much that a really good financial advisor should be doing and is doing that they don't have the time to do what we do. I like to say we continuously scour the investment universe looking for new and better investment ideas. Again, that's how I found David, going to a conference and uncovering new investment ideas. We still do that to this day. So financial advisors that really want to build differentiated portfolios, because look, if you're just going to do a standard 60-40 stock bond portfolio, you know, you don't need an OCIO. You don't need, I dare say, even a money manager. You buy 2 or 3 ETFs or index funds and you call it a day. But if you do that, you're not diversified, and you're going to take more risk than you think you are, and you'll have a bumpier ride than you should. And at the end of the day, that's the problem. Again, talk about defining the problem. That's the problem we think advisors should be solving for their clients on an investment standpoint. How do you build a smoother investment experience? And that's what we specialize in, is building a smoother investment experience through model portfolios that allow the advisor to grow to scale, that allows the advisor to spend more time with their clients, be it in marketing, be it in research, be it in planning, knowing their clients, whatever. We help the advisor do an even better job and be kind of that financial planning hero for their clients.
And what do you mean by smoother? I think I know what you mean, but define what you mean by smoother.
Yeah, so smoother to us is less downside volatility, right? And that's one of our mantras too, is having been in this industry as long as I have, it has always presented to me that standard deviation is risk.
Mm-hmm.
And standard deviation is not risk. My degree is in mathematics and economics. And if you look at what standard deviation is, it's the deviation on the up and on the down, right? And in 20 years of sitting across the table from individual clients, I never once met a client that didn't want deviation on the upside, right? People want deviation on the upside. They just don't want it on the downside. So we try to build portfolios that minimize that downside experience, right? While still having the necessary returns investors need to meet their goals.
Right. I'm 100% on your side, but I'd argue briefly on the other side, it's an easy way to say, hey, what tends to have the most downside deviation? Stuff with a lot of upside deviation, right? So it's kind of a lazy way to get there, but that's the support of standard deviation as the metric.
Sometimes, but
yeah, excluding managed futures, right? Which is lumpy and boom.
Yep. Yeah, and look, in a perfect theoretical world, it is a bell-shaped curve, right? You think a perfect bell-shaped curve that it's 50-50 on both bell-shaped curves, but we don't live in a perfect world. Last time I checked, so there is skewness to a bell-shaped curve, and you can have greater gain deviation and lower loss deviation with different asset classes and different strategies. And that's one of the ways that we do it is, and as simple as this sounds, we diversify. But when we diversify, we're not just diversifying with asset classes, right? That's the way it's always been done. You have your stocks, you have your bonds, you have your alternatives. We diversify with different asset classes, but also with different approaches and with different strategies, right? So, sometimes we're asked, what's better, quant or fundamental or technical analysis? Should you buy and hold? Should you be tactical? Our answer is yes, all of the above.
Yeah.
Because that is diversification, right? We diversify by having tactical managers that maybe use technical analysis and having managers that use fundamentals or quant or algo, right? And the diversification is, we actually call our portfolios in our OCIO model multi-dimensional. portfolios, which again is maybe a testament to the science fiction that we'll talk about. But
yeah,
we believe in multi-dimensional diversification. It's funny, we had this conversation with an advisor just this last week about non-correlation is not just binary. It's not just the correlation to stocks that should be measured. It's the correlation to everything in the portfolio. So it's not, oh, I have an alternative I used and it's non-correlated to stocks. And that's good. But what about another alternative? You can have multiple alternatives, investments, and they can be non-correlated to stocks, but also non-correlated to each other, right? So it's that multifaceted, multidimensional, portfolios that we build in the OCIO that truly help an advisor differentiate their practice as well, so that they can help to get new clients, and most importantly, help them meet their goals.
And just as you mentioned, the 60-40 in bonds in a portfolio, what are your thoughts of, right? We had this unbelievable 30-year run, rates from whatever, 8 to 0 or 19 to 0, whatever you want to quote.
Mm-hmm.
Surely, who knows, but surely that's not going to look the same over the next 30 years, right? So does that break 60-40? Does that just make the path look different? What are your thoughts there?
Yeah, I mean, it's a great question. And we've written about 60-40. Is 60-40 dead? Is it not dead? Look, in our model portfolios, our OCIO portfolios, we have a sleeve that is in essence 60-40, right? That is in essence, maybe it's 80-20, 20-80, that is beta weighted stocks, beta weighted bonds. But that's just a sleeve of the portfolio, right? It's certainly not everything. Are bonds going to look the way they did over the last 30 years? Absolutely not. I mean, you stated the reason yourself. But we're also believers in not trying to predict the future. Look, the market is predicting 6 or 7 rate cuts this year. I don't think the Fed is predicting that, right?
No.
And the Feds are the one that are going to do it. So, and I think the bond market may have priced a lot of that in already. If you look at bonds last year somebody would look at the full year of bond performance and said, oh, last year was a good year for bonds. I would look at last year's return experience, and last year was not a good return experience for bonds. You look at it month to month, day to day, bonds volatility, I forget what the metric is for bond volatility,
Move index.
Yeah, the move index, very high. And I have a chart that looks at what bonds did month to month. It went up 4%, down 4%, up 3%. It's not the return experience bond investors want. If it wasn't for the last 2 months of the year, bonds went up 12% in the last 2 months of last year. If that hadn't happened, bonds would have had their 3rd year in a row of negative returns. And, I asked folks, why did bonds go up 12% in 2 months? Did I miss the big Fed rate cut from Jerome Powell?
Yeah.
No, he didn't. But the market is forward looking. The market expects all these rate cuts. Well, guess what happens to bonds if we don't get those rate cuts?
Right back down. Yeah.
It's going to be problematic. So we implement, again, a lot of alternatives, a lot of bond alternatives into the models that we use, as well as equity-like alternatives, futures, you name it.
And David, maybe for you, or also so all those alternatives, which may be uncorrelated with each other, uncorrelated with stock bonds, you found yourselves moving towards managed futures and global macro. Do you find those have the most unique return profile out of all the quote unquote alternatives?
Yeah, especially when you get to ones that are more fundamentally managed as opposed to, trend following a system. Not that they're all the same, but they're all following a formula. And, most of the time when there's a fundamental aspect to it, it's more waiting till you see dislocations in things that are going to create opportunities down the road and knowing how to look for the signs of those things to come about, and so
example.
I think you should do the cocoa example, Brad.
My favorite. Yeah, it's my favorite example.
Example.
Yeah. So last year, there was a trade by our futures trading advisor in his program where he went long cocoa. and he went long cocoa because of a bad weather pattern heading towards the Ivory Coast, bad fertilizer utilization by the local farmers, and the crop was already having issues. So those are easily understood, especially by investors, reasons that could drive the price of cocoa higher. And those reasons have nothing to do with Tesla's deliveries this quarter, with the new Apple goggles that are coming out, with Jerome Powell, what he's talking about this month, right? It's totally non-correlated with causation, right? That's one of the key things that we look for in any investment is there a cause for the non-correlation? Otherwise, you just have happenstance, right? And if we can identify that there's a reason for the non-correlation, it's more likely that it'll continue to be non-correlated versus the happenstance. But the mispricing in the cocoa is a great example, and it turned out to be a profitable trade. And those types of kind of demand supply imbalances are what we look for.
I'm going to pitch the blog again. There's another post from way back when in my blog days of the picture from space that proves commodities aren't correlated. And it was a freak snowstorm in Montana in like June or July, maybe June. And no, it was later in the year, maybe August. But the cows hadn't grown their winter coats yet. So it killed off like 60% of the cattle in the right. And live cattle went limit up for like 4 or 5 days in a row. And right. And that has nothing, like you're saying, nothing to do with how many cars Tesla produced, nothing to do with the Fed, with GDP, anything. There was a storm and a limited commodity supply that caused issue.
And the only way to gain exposure, is through the direct commodity. Because sometimes we'll have somebody in our audience say, with our cocoa example, or you could use the cow example, the beef, well, I'll just buy Hershey's. If cocoa prices are going up, I'll just buy Hershey's. And we would say, well, think about it.
Actually have to buy that cocoa.
Yeah, Hershey's actually has to buy the cocoa from the farmers. I'm sure they're buying it through a few intermediaries first, but they're the ones that have to buy it from the farmers. And the cocoa prices going up actually hurts Hershey's and Nestle's earnings, not help it. Same thing with beef. You wouldn't want to buy, I don't know, Purdue or whatever the large beef seller is, but you need the direct, and that's the beauty of futures, is it's giving you that direct exposure that most investors do not have. Most advisors do not have that with their investors.
And how do you solve? The trick is there isn't this beef example and this cocoa example every month like clockwork, and those are relatively smaller markets. So how do you solve that problem of, cool, if this is uber successful and we have $6 trillion trying to get access to these kind of things, what do we do?
Well,
6 trillion might be a little high. Let's go with
6 trillion is a little much. Okay,
let's go with 600 million.
It is opportunistic by nature. Okay, because I mean there are always going to be trends happening, but there aren't super big trends all the time. And those wind up being super big trades that do great. So if you're approaching it from the fundamental side, a lot of times it gets into, we'll just call it, strong conviction ideas and concentrating positions. I mean, you still have to, do risk management, but there's a difference between having a strategy where you cut off the fat tail, the right tail, and because you want to just normalize your returns, but your overall return suffers typically when you do that because you're cutting off that profit. And having the conviction to build the position because you think you have fundamental reasons to think it's not done yet. We'll watch it, but it's not done yet.
And that was going to be the second part, right? So a trend follower has those positions, probably made money, but they're risking so little of the portfolio on just that market or just that sector that it doesn't really move the needle all that much.
It's kind of like going back to, I heard this years and years ago when I first started studying investing. Like Warren Buffett, right? And they were saying like, how should you diversify your portfolio? And he was like, well, if you have more than 20 stocks, I mean, that's probably too many.
Yeah.
Because that's the way he thinks, It's like you concentrate on ideas. I served him pretty well. And that's in the stock world, which is, to some degree more difficult because there's so much noise.
And so the idea is you're sourcing these discretionary, I'd call them, you're calling them fundamental, somewhat similar. And now there's kind of a new thing. We've had a few guys on the podcast, quantamental, right? They're kind of systematizing those fundamental views so they can run through a bunch of them more quickly.
Yeah.
So
Yeah.
finding a bunch of those and pairing them with traditional stuff, as well as trend following in some cases. Or are you calling those discretionary guys your global macro, so to speak?
Yes, the discretionary, the fundamental side is discretionary. The future side is discretionary.
Yeah.
And it's there's still all the risk management and everything in there. But the reason that I think that it's so additive to what we're doing is because it's different than what a lot of people do, because the process to get the ideas is different because it's all coming from up here. It's not an algorithm. It's everybody's unique. I mean, there's 100 trillion connections up here. Nobody's the same.
And I ask this with a lot of discretionary traders, like why doesn't Citadel or Millennium or whatever just right? They could analyze the same stuff, come to the same conclusions, right? Why don't they do what some of these discretionary guys are doing in hogs or cocoa or grain markets?
Well, who's to say they're not doing that some of the time, But yeah, I mean, you don't really know what they're doing, But they have so much money, they're doing everything that you could possibly do. They have to spread the money around because they'll affect the markets.
Right. Or I think the correct answer is it's not worth their time.
Or it's not worth
If
their
it's a
time.
$300 million opportunity, like whatever, we have better uses for that in bond world or currencies or whatever.
Yeah, and it's different by market too. I mean, the metals market's not that big. The agriculture market's not that big. The financial markets or the indices, they're a little bigger. The bond market, the FX market, they're a little bigger. But
well, I think you touched on something important, Jeff, with this is one of the reasons we chose to launch a mutual fund, right? I had a successful career as a financial advisor. I didn't wake up one day, I'm like, let's launch a mutual fund, right? It's in creating portfolios.
I always wanted to do that.
Right. The same as saying, let's stab a sharp stick in our eye.
Yeah. But when we look at the marketplace for what's available in, call it liquid alternatives or mutual funds or ETFs, there are some amazing products out there in the managed futures world, right? And we've used some of them in our OCIO solutions for advisors, and we still do because it pairs extremely well with our own mutual fund. But there wasn't a single mutual fund that we identified or ETF that was what we call fundamental, or you can call discretionary, based on the future side. The majority of them were trend following, algorithmic, and again, they're great funds and they provide non-correlation diversification. But again, we like building things with a causation for the diversification, and given that our strategy implements a fundamental program where it's discretionary, the correlation between our strategy and others is near zero, even though it's futures based. And managed futures is many times synonymous with trend following, and that's not what our program does at all. And it helps to give that diversification.
Is the trade-off there that you may not be there in like a classic 08 sell-off or a crisis period?
Well, I think if you have something that's happening that's obvious, you're going to be in it. But if you start having a pullback, you might not get out. You might just, especially if you're playing with profits, you just, because it's got further to go because you've done the research and supply and demand haven't evened out yet.
Right. But so it's like alpha, well, I kind of consider it's like alpha based diversification instead of structurally beta based, right? The trend followers are kind of saying, hey, we're not doing anything special here. We're capturing every breakout. 1 out of 10 of them is going to be the breakout where it's an '08 sell-off, and we're going to be there because we were wrong the 9 times before. It sounds like you're saying more like, hey, we might be wrong 1 out of the 10 times, but we're going to have high conviction on the other 9, 6 out of 10, probably not 9 out of 10, but something along those lines, right? Of like kind of flip that logic of we're looking for greater chance of success and greater conviction on those trades.
Yeah, more concentrated positions because the research has been done. And even if it doesn't pan out right away, as long as you hadn't hit your risk limits, you just wait it out. I mean, if an idea doesn't look like it's quite ready and it hits the risk limit, we might get stopped out in 2 or 3 weeks. If it starts happening, it might get added to. It could go months. It could be in the position for months. It could get rolled several times.
Yeah.
So it really is global macro.
When I hear global macro, I think back to broke the Bank of England. What's his name? George Soros, right? Of like, okay, I'm taking this big massive bet on this currency. And most other historical global macro guys have been kind of global GDP bets or like country currency bets, country rate bets.
Well, not necessarily, but I see what you're saying. I mean, that
yeah.
was,
So, but and then
obviously.
that was kind of more discretionary global macro, and now systematic global macro has kind of morphed into more trend following. So, just
Right.
you're saying this is almost another piece over here of like discretionary, more commodity focused global macro.
We've actually used that example before that you gave. Okay.
Yeah.
The Soros example, because it was just so he saw all the pieces coming together. So he made the bet and it worked out. Now it's historical because it all happened like at one time.
Yeah. It was like a cascade. It was,
yes,
when it happens, it
made
happens.
$1 billion in a day or something, but
But are you saying, are they more commodity focused or no? So some of
yes.
okay.
Yeah, it's across the spectrum. We trade 45 different markets.
So they'll be in rates, they'll be in stock indices,
Everything.
Got it.
Yes. Yes. And as a matter of fact, in 2020, we were short palladium of all things.
Yep.
And really had to do with it didn't have to do with COVID, which was kind of strange. It had to do with they were pulling palladium out of catalytic converters, and so there was going to be an oversupply, and the prices. But the manager saw it was going to happen. Shorted palladium. That was a very good trade.
And that goes into one of the I mentioned before about preparing versus predicting, right? It's like the manager didn't predict that there was going to be a global pandemic, right? He wasn't having lunch with Fauci one day and all of a sudden, it's like, oh, this is going to happen. There was no insight there. It was he was diversified beyond just stocks and bonds into palladium for reasons that were not related to global economic growth of equities or corporations. And he was just positioned a certain way in an asset class that moved in the right direction, regardless of what was going on with global pandemic issues, right? So it's the, there's a saying I like to use that says it's the bus that you don't see that hits you, right? Mm-hmm. So if everybody's talking about the bus and if everybody's talking about this is going to happen, this is going to happen, seldom is that the bus that hits you. It's the bus that's around the corner that you don't see, right? It's nobody saw global pandemic. Nobody saw bad things that happen. And sometimes it's a good bus that comes and picks you up, right? And maybe it's the iPhone. Nobody saw the iPhone coming until it launched, right? And that was a huge bus that carried a lot of people, or the Tesla electric vehicle or whatever, right? So it's being prepared and truly diversified, regardless of what happens, is our mantra.
Sorry, real quick. The add-on to that would be the bus that you don't see and the most people are unlikely to see. It's the one that hits all of them.
Yeah.
Right.
Sorry, David, what were you gonna say?
Um, I don't know. I'll think of it
I
in a
killed
minute.
it. Sorry.
Yeah, it's all right.
Um,
Oh, oh
and
yeah. I think the other thing that's important is the the idea that the process of coming up with the ideas, there's a process, but after that, it's pretty systematic in terms of position sizing and risk limits and all those kind of things that have to be done like everybody else has to do. It's where the ideas are being generated, but because that element is there, I think that if if unpredicted things come into the process, the manager has the ability to override the system, so to speak, because it's
yeah.
the system, okay, where that really doesn't exist in like system trading. Like there was an example when I was first starting to work with him, and I was, going through trades, and I looked at a trade, and I'm like, that's interesting. He's like short, and like and all of a sudden now he's reversed and he's long, and then it's this huge trade. And so I asked him about it. And I said, what happened here? And he said, well, we had this strong conviction on this, but there was a piece of information we didn't have. And when this piece of information came out, it literally flipped the narrative and the whole thing changed. And we just reversed our position. And you have the flexibility to do that and conviction based on, you know, based on all
Yeah.
those
On
economic
on new information. And
on
then
new
Brad,
information.
talk for a minute about the kind of traditional side of the mutual fund, right? So you're pairing, right, what my friends at Mutiny Fund would call the offense side with this defense side that's not correlated. So talk to us a little bit about the offense side.
Yeah. So we invest the equities primarily in U.S. equities, all U.S. equities for the most part, all a large company. We balance it between growth. So we put about 50% of the mutual fund in equities, about 20% is in growth-oriented stocks, about 10% is in what you'd call core kind of S&P 500 like stocks, and then another 20% is in more dividend-focused stocks, call it value, but we prefer more dividend focused than just pure value per se. Um, just as a way of making sure we're not buying cheap stocks that are cheap for a reason. They have strong dividends. We use ETFs currently as kind of the primary vehicle to get exposure to the equities, and we're active on the ETFs that we pick and rebalancing them and cognizant on any tax loss harvesting that might be necessary. But it's really designed to get market weighted equity exposure, and because it's non-correlated with the global macro side, it really helps to balance the two together, right? And sometimes we've been asked, like, well, what's the secret sauce of the mutual fund? Is it the global macro manager, or is it what is it? And it's really defined in the name of the fund. The fund is called the Dynamic Alpha Macro Fund. And we view dynamic alpha as that rebalancing alpha, right? We're able to rebalance between the two sides dynamically at the right time when one gets out of whack versus another, which then in essence allows us that ability to, sell high and buy low. And then things revert, because of the non-correlation. That helps to, um, all our analysis has shown that helps to keep returns stronger with minimizing the downside risk. So,
And
uh,
that's a model you came up with, the dynamic rebalancing, or is it done monthly, quarterly? Is it on a time schedule or
so
as
we
you,
have three thresholds along with kind of some time frames of quarterly.
so it's bands if it gets outside of a band reset?
Correct, correct.
Um, how do you feel? Have you done research on bands versus time based?
We have, yeah,
Yeah.
we've done a lot of that analysis, and we also try to be cognizant of the tax ramifications of over rebalancing can cost more, can generate more taxes.
Yeah.
Most investors invest in IRAs, but certainly not everybody does. So we try to be cognizant of balancing all those other costs along with performance. And that's why we kind of settled on threshold based bands along with kind of a quarterly time frame as well. And we've been blessed with positive flows into the mutual fund, and that allows us to kind of rebalance as flows are coming in as
Yeah.
well. So we've been able to not have to generate any tax gains on the equity side by rebalancing just from the positive flows that are coming into the mutual fund.
So, and what, real quick, then we're going to get into sci-fi. What's the limit, in your opinion, of diversification, right? If you're adding like, would you go so far like we're having life settlements and we're doing cat bonds and we're doing, right? Like, what's the practical limit of what you would consider enough diversification and stuffing things in there?
Well,
in the fund or?
Well, yeah, I mean, I know there's regulatory constraints on that. So just pretend you have a vehicle that could do anything.
Yeah, I mean, the alternative.
That'll be our entree into sci-fi. The
sci-fi
world where any investment could be made in any investment vehicle.
Yeah, I mean, because that's the thing is sometimes I like to refer to alternatives as the alternative to alternatives, because to a lot of investors or advisors, alternatives are real estate or gold or silver. And to us, alternatives means a lot more. It means merger arbitrage, dividend capture, managed futures, global macro, buffered, structured notes, you name it, right? Yeah, life settlement and some of those other things, very esoteric out there. Yeah, it's a matter of getting the right vehicle, and there's a ton of those alternatives, litigation financing, and things like that can really stretch the envelope of what's out there, and we love exploring it. We have a long watch list of things that we're always tracking, and it's tough to fit things in a simplified portfolio, which is also one of our objectives. It's one of our taglines of simplifying complexity.
Right. It doesn't matter if you have the best space shuttle, to borrow from earlier in the conversation, if you can't get any people in it, if you can't fly it.
Correct.
Right.
Correct.
And you probably agree with me here. The deeper I go down into those quote unquote alternatives, they're more alternative strategies they're just different flavors of stocks, bonds, credit. And they're mostly they need GDP growth and a great economy. They're cool. Yeah. And they do a lot of cool things, and they're non-correlated most of the time. I think the problem is back to that concept of fundamental non-correlation. Like they don't necessarily have that. If things break, credit dries up, all this stuff, they're likely going to break as well.
We like to ask the question, what's going to drive the return, right? What's the return driver, right? So like with our cocoa example, there's 3 identifiable things that are going to drive that return, right? And yeah, it's the key part is what is going to drive the return, because one of the very popular alternative investments these days is private equity.
Yeah.
And
popular is an understatement, but yeah.
Yeah. And it's funny because when I talk to folks or meet folks about, they talk about, oh, I'm in private equity. I'm like, oh, you're in equity.
Yeah.
And at the end of the day, private equity is equity.
It's right there in the name, folks. Yeah.
It's right there in the name. And I think it's Cliff Asness, right, from AQR. He uses the term volatility laundering.
Yeah.
And look, we think anything can work, and private equity can have its role, but you just don't want to fool yourself to thinking that it's going to be non-correlated. If it's going to be driven by, economic growth, it's like an equity, because it is.
Yeah.
It's just private.
Yeah. You just can't redeem it as quickly.
Right. Yeah. It used to trade at a discount because of the liquidity, and now it trades at a premium because of the right. Oh, I don't have to see the real returns on a daily, monthly basis. I'll pay you extra for this.
Yeah. You can get that with regular equities too. You just don't open your statements or log on to your investment account for 3 months.
The old Rip Van Winkle approach. All right, let's get into a little sci-fi. So you guys bonded way back when in the first conversation? You're like NASA.
Yeah, I don't remember when when it came up. I think we're just befriending each other, and I mentioned to David that, I'm going to go to the Star Trek convention this weekend, because the largest one is in Vegas every year.
Yeah.
Even when I lived in
Chicago.
Hilton,
used to be, right?
Used to be at the Hilton. It's at the Rio now. It's run by Creation Entertainment. I don't think it's actually called the Star Trek Convention anymore. They had some trademark issues, so I think it's called something else. But in essence, it's a convention full of Star Trek fans, and all the actors come to it. And Creation Entertainment does an amazing job putting the conference on. And I mentioned to David I was going, David's like, oh, I'm a Star Trek fan, And then I said, well,
Trekkie, we can say, right?
Yeah. And then I said, well, why don't you come? And I had a spare ticket, and David came, and he might be looking for.
If he puts on like a Klingon forehead, I'm gonna lose it.
Not quite, but oh yeah.
Oh, nice.
Yeah, that is right.
Yeah, Captain Kirk, Shatner.
That's
should be worth $7 billion or so. He had all that Expedia stock, but he puked out of it in like 2009, I think. He sold it all at $1.
Yeah. Yeah. David, tell him your story about kind of William Shatner. And
so I kind of always wanted to meet him, but it just, didn't have the opportunity, obviously. But he was my inspiration for getting into the space program. So when I was 10 years old, I turned the TV on, and it was just happened to be, they didn't have reruns back then for the most part. It happened to be the first episode of Star Trek. Wow. Was on TV. And first one with the salt monster, the whole 9 yards.
Yeah.
And I was enthralled. You're 10 years old. It's like, what is this? So I was hooked. And right then I decided I'm going to be an astronaut.
Wow.
I want to be an astronaut. So after I got older, I realized, the math is I got about a 0.02% chance of getting to be an astronaut. So I'm just going to work in the space program. So I'm going to be an engineer and work on spacecraft, meet astronauts. And I actually did wind up going to Johnson. I was there for 5 years and worked with astronauts designing the space station. Was in meetings with them all the time and just had a great time. But I always wanted to thank Shatner because he's the guy that set me on that path. Or it never would have happened. Just happenstance. Yeah. So I actually got to meet him and tell him that story. And got a photo op with him. And of course, he said, "Oh, that's great. I'm so happy for you."
Yeah.
Like he probably did it 10,000 times that day.
Yeah.
And then you've got a little, like my poster behind me, of sci-fi, not just Star Trek, but sci-fi into investing. What's your take there?
Yeah, so we have a blog on our website too. There's a few blogs. There's a blog we have on what Star Trek can teach you about investing. And nice. I love your infographic as well on the Star Wars. I've sent that to a few folks. And I think it was a few years ago. It was earlier last year. The promoters for the convention here in Vegas sent an email out to everyone who had a ticket and said, if anyone has an interesting topic they'd like to talk about, shoot us an email. And I asked David, do you think the Star Trek fans would like to hear about investing? It's like,
maybe
everybody likes talking about investing. Everybody needs money, right? So we shot him an email and said, hey,
not in Star Trek, right? There's no need for money.
Star Trek doesn't use money, but the Ferengis do with their gold press platinum.
We brainstormed ideas, put shields around your portfolio.
And that was one of the keys on why we did it, was because, as a financial advisor, I know investing can be scary for investors. And there's a lot of terminology. There's a lot of jargon, people on CNBC moving fast, using scary terms. And as a financial advisor, I always tried to speak plain, understandable English because I wanted my investors, my clients, to be comfortable. And if a confused investor is not a comfortable investor, right? So we went there with the goal of, let's talk in Star Trek language. Let's talk in terminology that everybody there can relate to.
We should have done that the whole pod next time.
Yeah, we should. But one of the things I've always enjoyed going to these Star Trek conventions is there's people from all over the world go to these conventions, from all different races, creeds, political beliefs, you name it. And everybody gets along because everybody looks at, what do we all have in common? Our love for science fiction and Star Trek. Let's bond on that, put our differences aside, and everybody gets along, right?
Which sort of Gene Roddenberry's idea in the first place, right? Of like, hey, in space, we're all equal and everyone's cool.
If Klingons and humans can get along, why can't Democrats or Republicans?
Yeah.
But it happened. You spoke at the convention.
We spoke at the convention. We stood on the stage and spoke at the convention, and it was to individual investors, retail folks.
You have a costume on?
We did not. We did not
No.
have costumes on,
We
and
did have a few Klingons in the
there
audience.
were some
Nice.
Klingons in the audience, actually,
Yes.
which is probably a first for a
They
financial
said
talk.
kapla.
Yeah. And give us what were some of the corollaries?
Shields around your portfolio to protect yourself, right? I mean, we talked about risk tolerance and understanding yourself. We did a cute little quiz, like who would be, the biggest risk taker in from a character standpoint, right? Maybe it's Worf, maybe it's Captain Kirk, always out there taking risks. Who would be the most conservative? Who's the most nervous Nelly Star Trek character you can think of? And
Yeah.
it was Barclay, if you remember
Mhm.
Barclay from
Yeah,
Next
yeah, yeah.
Generation, always nervous and scared, right? And it's like the
Until he
portfolio.
became super being.
And of
Yeah, he
course, he
came
was
super
most
being in one of
logical.
those.
Yeah.
But you can have a portfolio for a risk taker like Worf or Captain Kirk, and that
Yeah.
works great for them. But you put that portfolio for Barclay, who's a nervous Nelly, it's not going to work. So it's
Mm.
understanding yourself, understanding your risk tolerance, and then building that portfolio to fit you, right? And I think we ended it with understanding that goals matter, right? And defining the problem. We shared David's story about, that the capsule doesn't have to be indestructible. It just has to get people back alive. So are you defining your financial goals correctly? And your financial goal should not be to beat the S&P 500 every year, right? Your goal should be, as Spock famously said, to live long and prosper,
Mm.
right? And
Yeah.
that's the goal, is to retire, to send your kids to college, to exactly, right, live long and prosper. That's what everybody aspires to do. And that again lines up with your correct risk tolerance. And so it was
Did
it was a fun presentation. We got great feedback from folks, and
Well, we'll put the link to the blog in the show notes. I've
yeah,
always wanted to, I would have loved to get in there and be like, hey, they failed, every series has failed risk management 101, right? They're not supposed to send the captain on away missions. He always goes on the away mission.
correct.
Uh, but and then in later ones, they would even quote it like, oh, sorry, Captain, you can't, I'm going.
Yeah.
Hell with you.
Yeah.
It took Picard a while. It
Yeah,
took
true.
Picard a while before he got off the ship.
And then you could have worked also in like red shirt, who the guy who's going to
Yes.
die in your portfolio. Know who the red shirt is. Awesome. I just want a few of your favorites while we're on the topic. Favorite series?
Star Trek series Voyager for me.
Voyager. Really?
I like the Next Generation.
Yeah, that would be my choice too. I thought you were going to go with the original since it inspired your early career.
It did. It did. And it has a special, it's not in, it's not in with the other categories.
Got it. It's a whole separate thing. And then there's the series.
Thing.
Yeah. Favorite movie? Tougher. I'm going to go with Wrath of Khan.
Wrath of Khan is a great one. I like what's the one with the whales?
Voyage Home. And then the new ones are pretty good with Christopher Pine.
J.J. Abrams ones are really good.
Yes. I really think that Ricardo Montalban should have won the Academy Award. And I'm not saying that, but I mean, the only reason he didn't was because it was Star Trek.
Yeah. He was throwing 100 miles an hour.
He was
put it in sports parlance. And favorite character?
Oh, it's a tough one. Well, Captain Kirk.
Captain Kirk. I think I'll go Data. And then
yeah, I would agree with any of those. I think Picard, you name it. It depends on the mood, right?
True.
Felix to me is one of the most hilarious characters, right? And but depends on your mood.
Yeah. And then do you guys ever have, I've been in meetings where I say Data, like data. I'm like, sorry, Star Trek fan.
Well,
not the human.
Yeah. And it's David and I had a fun experience when we were launching the mutual fund, and okay, now we have to pick our ticker symbol. So what should our ticker symbol be? And we work in a Star Trek terminology into our ticker symbol somehow.
On something PHSON.
And I think we even looked at data or something, and I think it was taken or something like that. But it's data. We all know.
It is what it is. All right. We've taken up a lot of your time here. So any last thoughts for listeners?
No, we appreciate you guys. We appreciate you allowing us to speak, and appreciate everything you do to help communicate the message on diversification and alternatives. And we love your analogies too, with your blogs and the Star Wars analogy you have with the poster behind you. There's some great ones there. We have a blog. We have monthly updates for our fund where we go through details on what's working, what's not. So feel free to go to our website, Dynamic WG, as in Dynamic Wealth Group, dynamicwg.com. And you can always email us at info@dynamicwg.com, and that maybe we'll put in the notes too. But yeah, we appreciate you.
Ditto. You going to the Super Bowl or any of the festivities, or stand far away from that circus?
Yeah, I'm more of the one that stays far away from the circus. God bless the people that come to Vegas and spend their money and keeps my taxes low and keeps the economy and all the wonderful people here employed. So
that was, when did the Bears were last in at 05 in Miami, and it started raining. It was like 50, and it started raining sideways, and it was just as coldest I've ever been. 50 degrees in Miami because you're soaking wet, and I'm thinking through my mind. Then they started losing. It's going to be 4 hours until I'm able to dry myself out, right? Like I have to get through the stadium, got to get on a shuttle back to this parking lot, back to the car, all the way back to the hotel.
Wow.
So yeah, it's not all it's cracked up to be. As soon as your team starts losing, you're like, what am I doing? Why did I spend all this money?
Yeah.
But I'm sure it'll be fun.
It'll be good.
Yeah.
Great. Well, thank you guys. We'll talk soon.
Thank you, Jeff.
And best of luck with everything.
Really enjoyed it. Thank you.
Okay, that's it for the show. Thanks to Brad. Thanks to David. Thanks to RCM for sponsoring. Thanks to Jeff Berger for producing. Live long and prosper.
You've been listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCMAlts and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.